Matt Bouchard with NAREIT.com. Here for this edition of Fundamentally Speaking, I'm joined by Calvin Schnure, NAREIT's Senior Vice President of Research and Economic Analysis. Calvin, thanks so much for joining us.
My pleasure, Matt.
Now, I want to talk today about the T-Tracker, which is NAREIT's quarterly summary of operating performance of the entire listed REIT universe. What do the latest numbers tell us about the REIT operating performance that we saw in the fourth quarter?
REITs had solid operating performance in the fourth quarter of 2015. Funds from operation continued to rise for most REITs, as did net operating income and dividends paid. Total FFO was $12.2 billion. That's up nearly 10% from the fourth quarter of 2014. NOI was up 13% to $20.3 billion, and total dividends paid were $11.8 billion. That's a 5% increase. FFO did fall on a quarterly basis. There were a couple of REITs that had some significant impairment charges, but if you exclude those impairment charges, FFO actually was up 1.25% on a quarter-over-quarter basis.
Now, obviously, REITs own a wide range of properties, from offices and retail centers to apartments, data centers, healthcare facilities. How did the different sectors perform?
There are three sectors that really stand out in terms of same-store net operating income. I look at same-store NOI because that lets us take out the effects of acquisitions. Sometimes REITs have had fairly rapid growth because they acquired properties. Same-store tells us what was the operating performance on a store-by-store basis. Self-storage had a really spectacular year, up 8.9% over the fourth quarter of last year. We've seen that sector has been performing very well, both in operating performance and in the stock market. Manufactured homes and apartments were up 6.8%, 6.6%. These are two sectors that have been performing quite well. What it reflects across the board for these is you're having continued robust demand and limited amount of new supply. So this is a very optimistic outlook for these sectors. Most other sectors still had moderate gains. Office had a 3.25% increase over a year ago, and industrial was about the same. We did see some slowing in the same-store performance of healthcare to about 1.5%. That's about half of the rate that we had seen previously. There's a bit of excess supply in some of the sectors of the healthcare, but overall, it's very favorable for most sectors across the board in terms of same-store NOI.
So it sounds like 2015 ended on a rather high note. What else does the T-Tracker tell us about expectations for 2016?
Two things jump out of the numbers as far as the outlook. One, net acquisitions have really slowed. REITs have been acquiring quite a bit of properties during 2013, 2014, and the first half of last year. That has dwindled. The cost of capital has risen because the share prices are off from their highs. In the fourth quarter, we did see some positive acquisitions for the sector as a whole, because self-storage and data centers in particular were acquiring, but many other sectors were actually net sellers during the quarter. So that's going to limit the headline growth of NOI from an expanding overall size of the sector. On the other hand, the occupancy rates have risen to a record high. Occupancy rates are really important in terms of not only the income they're getting from the properties, but also high occupancy is going to give you more pricing for rent increases in the future. We saw an increase in headline as well as in many sectors. So the high occupancy rates really bode well for the sector in 2016.
Okay. Calvin, thank you so much for joining us.
My pleasure, Matt.
For more on this and other REIT news and analysis, be sure to visit REIT.com.